Welcome to the Deep Dive. We're here to cut through the noise and give you the key insights from the information you share with us.
That's right.
Today, we are diving into the recent earnings call for Costco Wholesale Corporation. This is for their third quarter of fiscal year 2025.
And it was quite a call, painted a picture of a business that's, well, really executing strongly.
Yeah, delivering some robust numbers that kind of seem to defy some of the broader economic chatter out there.
Absolutely. The performance they reported for Q3 fiscal 25 was definitely solid. It reflects, I think, both ongoing business momentum and some pretty effective management in the current environment.
Okay, so let's kick off with the headline numbers.
Yeah.
Straight from the CFO, what was the top line story?
Right, so net sales for the quarter came in at $61.96 billion.
$62 billion almost.
Yeah, and that's an increase of 8% compared to the same quarter last year.
8% growth, that's pretty healthy. And how did that flow down to the bottom line, the income statement?
Net income was particularly strong, $1.9 billion for the quarter, which works out to $4.28 per diluted share.
Right.
And that's a significant jump, over 13% higher year over year.
Okay, a double-digit increase in net income, that's certainly impressive. Now, when we look at comparable sales or comps, right, that's often the key health metric for a retailer. What do those numbers tell us?
Yeah, comps are crucial. So overall, company and comparable sales were 5.7%.
5.7.
And this is key, when you adjust for things like gasoline price deflation, foreign exchange swings.
Right, the noise.
Exactly. That comparable sales figure actually jumps to a really robust 8%.
8% adjusted, okay.
And that adjusted number, it gives you a much clearer view of the underlying merchandise growth.
That's a strong signal. How did that break down regionally? Any standouts?
Well, regionally, the U.S. saw adjusted comps up 7.9%. Canada was up 7.8%. Pretty similar. And their other international segments collectively grew 8.5% adjusted.
Okay.
And, their e-commerce channel just kept its impressive run going, posted a 15.7% increase in adjusted comparable sales.
15.7%. That e-commerce number, it just keeps standing out quarter after quarter.
It really does.
Let's break down those comps a bit more. Can we look at traffic versus the average ticket size?
Yeah, good point. So worldwide shopping frequency, that's traffic, increased by 5.2%.
Okay, more people coming in.
Definitely. Now, the average transaction size or ticket was up only 0.4% worldwide on an unadjusted basis.
It seems low.
Right. But again, adjust for gas deflation and FX, and that worldwide ticket was up a more meaningful 2.7%.
Ah, there it is.
Exactly. And for the U.S. specifically, traffic was up 5.5%, and the adjusted ticket was up 2.3%.
So bottom line, growth is definitely being driven by more shoppers walking in or clicking, and they're spending, a little bit more on average per trip once you strip out the gas and currency effects.
Precisely. Solid performance all around on the top and bottom lines, fueled by both more visits and slightly bigger baskets.
Okay, let's take that deeper dive then. Let's get into the drivers, starting with your foundation, right? The membership model. What's the key insight there from Q3?
Well, the absolute key insight here is just the continued strength and honestly the value of that membership base. Membership fee income, which, is largely pure profit for them, rose to $1.24 billion in Q3.
$1.24 billion just in fees.
Yep, and that's up 10.4% year over year, or 11.4% if you exclude the FX impact. It just really underscores the loyalty they command.
And we know those renewal rates are usually like stratospheric for Costco.
Yeah.
Do they hold steady?
They remain incredibly high. You're right. 92.7% in the U.S. and Canada.
Wow.
And 90.2% worldwide. Now, management did note a slight decrease from the previous quarter's rates.
Okay, slight is definitely the word to emphasize there. But, even a tiny dip is worth asking about. What did they say caused it?
They were pretty clear. They said it's primarily due to how newer cohorts are now factoring into the calculation for the first time.
Newer cohorts? Like who?
Well, specifically members who signed up during a promotion back in fall 2023, and also a higher percentage of signups coming from online.
Ah, okay. And online renewals are different.
Historically, yeah, members acquired online have shown a slightly lower initial renewal rate compared to folks who sign up right there in the warehouse. But management stressed these digital members are still a net positive for growth, and they tend to behave more like warehouse signups over time.
Right. that makes sense. So maybe a little bit of a mix shift impacting the metric, but not really a red flag about member satisfaction or anything fundamental.
Exactly. It doesn't seem to be, based on their comments.
So how many members are we talking about in total now? What's the scale?
They ended Q3 with 79.6 million paid household members.
Almost 80 million households.
Yeah, and that's up 6.8% year over year. Total cardholders, including the extra cards, reached 142.8 million, up 6.6%. Just solid, consistent growth.
And what about the executive members, the ones paying for the higher tier?
Still a major growth engine. Executive memberships grew 9% year over year to 37.6 million.
9% growth in that top tier.
Yep. And get this, these members represent just under half, 47.3% of paid households, but they accounted for 73.1% of worldwide sales.
73%. That's incredible. That one statistic really tells you so much about where the sales growth comes from, doesn't it?
It absolutely does. It shows that the executive membership value prop, with the 2% reward, really clicks with their most engaged and highest spending members.
Boy, that's a huge part of the story. Let's pivot now to margins, gross margin specifically. What's the key takeaway from their gross margin performance in Q3?
The key insight here, I'd say, is that the core gross margins actually improved. This was driven by some operational efficiencies and favorable commodity costs. But, and it's a big but, this improvement was partially offset by a pretty significant non-cash accounting charge related to inventory inflation, specifically on imported goods.
All right, walk us through the numbers then. What was the reported rate?
The reported gross margin rate was 11.25%. That's up 41 basis points year over year.
Okay, 0.41% higher.
Right. And if you exclude gas deflation, the improvement was 29 basis points, so 0.29%. Their core merchandise margin, specifically just the goods, was higher by 36 basis points or 27 basis points without gas.
And what drove that core margin improvement? You mentioned efficiencies in commodities.
Yeah, two main things. First, strong sales leverage in their fresh departments. Basically, higher sales volume helped cover fixed costs like payroll and, importantly, reduced waste, spoilage. That boosts margin.
Makes sense.
Second, they definitely saw a tailwind from lower commodity costs. Specifically for items in fresh and food and sundries, they called out things like dairy, butter, eggs, olive oil.
Stuff that had been high before.
Exactly. And they gave examples like lowering prices on butter by about 7%, like $1 a unit, and eggs by around 10%. And even with those lower prices, their margins in those categories actually normalized or even improved because their input costs went down even more.
So they passed savings to members and helped their own margin. That's like the Costco model textbook example right there.
Pretty much. But you mentioned that offsetting factor, a LIFO charge. Okay, first, what exactly is LIFO and what happened this quarter?
Right. LIFO stands for last in, first out. It's an inventory accounting method. So in a period where prices are rising, using LIFO means you assume you sold your newest, most expensive inventory first. This results in a higher cost of goods sold on paper and therefore lower reported profit and margins.
Okay, got it. So what was the charge?
In Q3, they had a $130 million LIFO charge, and that specifically reduced the gross margin rate by 23 basis points.
130 million? That's significant. And how does that compare to last year?
Yeah, it contracts sharply. Last year in Q3, they actually had an $11 million LIFO credit. Yeah. So when costs were maybe falling or less inflationary.
Wow, that's a huge swing then, like a $141 million difference year over year just from that accounting line. What's causing this charge now?
Management directly linked it to the return of low single-digit inflation, specifically in non-foods, and even more specifically, imported items.
Okay, so inflation creeping back in certain areas.
Right, and they clarified, too, that the $130 million wasn't just for Q3. It was actually an adjustment to catch up their year-to-date LIFO estimate based on the inflation they've seen so far this fiscal year.
Ah, a catch-up. And do they expect this LIFO impact to continue? Did they give any guidance?
They did. They estimate an additional maybe $40 to $50 million LIFO charge in Q4 if the current low single-digit inflation rates in non-foods, particularly those imported goods, persist.
So it signals that, yeah, while overall inflation isn't maybe what it was, they are seeing cost pressures tick back up in certain parts of their inventory, mainly coming from overseas.
Exactly. Okay, that's a clear explanation of a potentially confusing item. Good. Moving down the financials, what about SG&A? Selling, general, and administrative expenses.
Right, SG&A. That rate increased by 20 basis points year over year, coming in at 9.16%. Adjusted for the gas deflation impact, it was about 11 basis points higher, or worse, depending on how you look at it.
And what was the main reason for that increase?
The primary driver was increased wage costs, specifically in their operations component. This reflects the impact of employee wage increases they've implemented, including a new agreement that kicked in back in March 2025, and also a prior increase from July 2024.
So investing in their people.
Exactly. Now, these higher costs were partially offset by, again, that sales leverage from strong comps and some productivity improvements.
So investing in the workforce is hitting expenses, but strong sales are helping absorb some of that pressure. Makes sense. Okay, let's shift gears a bit. Talk about strategic investments in operations. How are they spending their capital? What's the CapEx look like?
They spent about $1.13 billion on capital expenditures just in Q3.
Over $1 billion in one quarter.
Yeah. And they estimate the full year CapEx will be slightly over $5 billion. So that really signals they're continuing to invest heavily back into the growth and the infrastructure of the business.
$5 billion plus. Where's that significant investment primarily going? New stores.
A large chunk is definitely going into opening new warehouses, yes. They opened 9 in Q3 alone and plan to open 10 more in Q4. So 19 openings just in the back half of the year.
19, wow.
They expect 24 net new warehouses for the full fiscal year. That'll bring their total count up to 914.
914 warehouses globally. That's huge scale. Any interesting strategic points about where they're opening?
Yeah, actually, they highlighted something interesting. Building new warehouses in areas that might actually cannibalize some sales from existing really high volume locations.
Cannibalize? Why would they do that?
It sounds counterintuitive, right? But the goal is actually to improve the member experience by reducing crowding in those super busy stores and just providing more convenient locations for members in that area. Relieve the pressure.
Okay. Thinking long-term about member satisfaction over just maximizing single-store sales.
Seems like it. And they're also investing significantly in their supply chain and their depot network. And these aren't just warehouses sitting on inventory. They're designed for efficiency, high throughput, helping move goods faster.
Mm-hmm.
They specifically mention investments on the West Coast to build out their Costco logistics network. And they directly linked that investment to the margin improvement we saw earlier in their e-commerce business.
Right. That connection between logistics investment and better e-com margins makes a lot of sense. Okay, let's dive into merchandising then and their pricing strategy. How are the core categories performing inside the store?
Core categories looked quite good, actually. Fresh foods saw high single-digit comps. Meat, specifically, was in double digits.
Double digits for me is strong.
Yeah. Food and sundries also solid mid to high single-digit comps, particularly strong performance in cooler and frozen items.
Wow.
And non-foods, interestingly, delivered high single-digit comps as well.
With tough comparisons.
Exactly. That's impressive because they were up against really tough comps from last year's, strong bullion and gift card sales. And within non-foods, they saw double-digit growth in several discretionary categories.
Discretionary? Like what?
Things like golden jewelry, majors, which is large appliances, electronics, toys, housewares, and home furnishings, all double digits.
Okay, double-digit growth in discretionary stuff definitely catches your eye, especially given the current economic climate chatter. What's their overall pricing philosophy right now? Still focused on value?
Absolutely. If anything, even more so. Their consistent philosophy remains laser-focused on competitive pricing and just delivering value to the member.
How are they doing that specifically?
Through a few ways. Targeted price reductions on key items. Increasing the penetration of their Kirkland Signature private label, which, by the way, is growing faster than their overall sales. Its penetration is up 50 basis points year over year.
Kirkland Signature keeps gaining share.
It does, and also leveraging local sourcing where it makes sense. They gave an example, sourcing their KS Ultra Clean laundry detergent in Asia for those local markets, which actually reduced the price there by about 40%.
Wow, 40% price reduction.
Yeah. And they reiterated raising prices is always, always the last resort for them.
That commitment to value is just so core to their model. How are they navigating this complex and, frankly, evolving landscape around tariffs? That seems like a big headwind, potentially.
Yeah, definitely a key area of focus they discussed. They're actively working to mitigate tariff impacts. How? By working closely with their suppliers, strategically shifting sourcing to other countries when it's feasible, pulling forward inventory on seasonal goods that might get hit, and just leveraging their global footprint to optimize shipping and sourcing. They really believe their model, limited SKUs, deep buying expertise, gives them the agility to navigate this complexity effectively.
And maybe even gain an advantage.
That's the idea. They think they can maintain or maybe even widen their value gap compared to competitors who might not have that scale or operational flexibility to react as quickly.
Okay, interesting. Let's move on to digital and technology, another area you mentioned they're investing in.
Absolutely. And we already touched on that strong 15.7% adjusted growth in e-commerce.
Right. So what specific initiatives are driving that? What are they highlighting on the tech and digital front?
Several key things. They recently launched a buy now, pay later option with a firm. That's for big ticket online items. And they reported positive initial sales results from that.
BNPL for big stuff. Okay.
In the warehouses, they're piloting new tech to speed up the front-end checkout. Things like pushing the use of the digital membership card through the app, and also testing scan-and-go type technologies. They said those are showing positive early results and good member adoption.
Trying to tackle those checkout lines. Are they using tech for personalization too?
Yes, they are. Implementing more targeted marketing campaigns online. They mentioned a Mother's Day campaign aimed at people who bought gifts before, and they're developing personalized product recommendation hubs online based on your browsing history, new arrivals relevant to you, local bestsellers, that kind of thing.
Getting smarter with the data. And that Costco logistics network you mentioned earlier, how's that contributing specifically?
Yeah, Costco Logistics is a huge driver of their online growth, especially in those big and bulky items. The value proposition of including delivery, installation, sometimes even haulaway for things like appliances or furniture, that's really resonating.
That convenience factor.
Totally. They reported a 31% increase in items delivered through their own logistics network just in this quarter. It really shows members are increasingly using this service for those large online purchases. It's working.
31% increase in deliveries is massive.
It is. They also gave a quick shout out to Costco Next. That's their curated online marketplace featuring partner brands. That platform continues to see really healthy year-over-year growth. They said Q3 FY25 sales alone equaled the total sales for all of fiscal year 2022.
Wow, doubling down there too.
Yeah.
And a strong pipeline of new vendors joining.
Yep. So you see strategic investments across the board, physical location, supply chain, digital capabilities, all seem to be contributing positively.
Okay, finally, let's touch on their view of the broader world. What was their commentary on the macroeconomic environment and inflation?
They noted that inflation in fresh food and food and sundries seemed relatively stable, kind of low single digits, similar to last quarter.
Okay, food inflation steady-ish.
But, as we discussed with that LIFO charge, they did see a return to low single-digit inflation in non-foods. And again, primarily driven by imported items, particularly from China. They mentioned China accounts for about 8% of their total U.S. sales.
8% exposure there. And how are they seeing consumer behavior reflected in sales? Are people pulling back?
Management described members as remaining, quote, choiceful in their discretionary spending.
Choiceful. Careful, but not stopping.
Seems like it. Responding well to value, quality, and newness. So, if Costco offers something compelling, people are still buying, even discretionary items. On the supply chain front globally, they see it as relatively stable overall, but delivery dates are still less predictable than they were pre-COVID.
Still some friction there.
A little bit. And while spot shipping rates have gone up recently, they noted that most of their shipping is covered by contracts, so that limits the immediate impact.
Okay, so it really sounds like they're navigating these macro cross currents pretty effectively.
Yeah.
Executing on their core strategy while making these significant investments for the future.
That's definitely the picture painted by these Q3 results, yeah. The strong financial and operational performance really demonstrates the resilience of that membership model and their value proposition, even with ongoing inflation concerns and, tariff uncertainty hanging out there.
Their focus on operational efficiencies, tech investments, and that strategic supply chain management seems to be paying off and positioning them well.
I'd agree with that.
Which brings us nicely to our segment. This is not financial advice.
Ah, yes, the fun part.
Where we put on our hypothetical hedge fund analyst hats and pitch an outrageous but plausible trade idea based only on what we just discussed from this earnings call.
And let's stress again, this is purely hypothetical entertainment, really. It should absolutely not be considered financial advice. We're just riffing on the commentary.
Couldn't have said it better myself. With that crucial disclaimer crystal clear, let's hear the first hypothetical pitch.
All right, idea number one. Let's call this the tariff arbitrage and supply chain power play.
Ooh, sounds fancy.
Right. So Based on management really emphasizing how they're strategically shifting sourcing using their global scale, leaning into US-made goods maybe to mitigate these tariff impacts. The hypothetical pitch is this. Consider a pair trade.
Okay, long short.
Exactly. You'd hypothetically short a basket of smaller, maybe less agile public companies, ones that are heavily exposed to those specific high tariff imported non-food categories Costco mentioned, are seeing inflation. Think certain suppliers of furniture, housewares, electronics maybe, who rely heavily on specific import lanes and just lack the buying power or the operational flex to pivot sourcing quickly.
Right, the ones that get squeezed.
Precisely. Simultaneously, you go long Costco. The bet here is that Costco's unique ability, their scale, their sourcing adaptability, their logistics control, their value delivery will let them navigate these tariff pressures far better than those smaller players, allowing them to potentially gain market share as they sort of arbitrage the tariff landscape through sheer operational excellence.
That's an interesting angle. Betting on that operational gap between a giant like Costco and smaller competitors in a really complex environment. Okay, what's hypothetical idea number 2?
Okay, this one we'll call the bundled logistics dominance play.
Logistics focused.
Yeah. We heard about that exceptional e-commerce growth being driven significantly by Costco logistics, right? That 31% jump in items delivered, especially big and bulky stuff with installation and haul away included.
Yeah, the 31% was a big number.
It really was. And it strongly suggests that consumers buying large items online are increasingly prioritizing that seamless bundled delivery and service experience. So the hypothetical pitch. Go long Costco, obviously, betting on continued e-com penetration powered by the distinct value prop of their logistics network. But pair this with a long position in, say, a specialized publicly traded logistics or installation service provider, one that focuses specifically on complex last-mile delivery for large goods.
So betting on an external player, too.
Yeah, the idea is even if other retailers can't fully replicate Costco's in-house network scale, the market trend towards demanding these bundled delivery services will grow overall. That could benefit companies who partner with various retailers or who are just leaders in this specialized niche space. They could kind of ride the wave of demand that Costco's success is partly demonstrating.
So betting on both Costco's internal strength and the broader market shift towards more complex delivery solutions for big stuff. Both are certainly creative hypothetical takes based purely on the data points from the call.
Purely hypothetical, based only on the earnings call commentary we discussed.
Indeed. So, all right, let's wrap up our deep dive into Costco's Q3 FY2025 earnings call. The key takeaways seem to be strong financial results across the board, effective management of costs, and significant investments in key areas like wages and infrastructure.
And a continued strategic focus on maintaining that intense value for members through smart merchandising, growing digital capabilities, and actively navigating external pressures like tariffs and inflation.
Yeah, the call really underscored the resilience of their business model and just their operational strength in executing against it, even in what's still a pretty mixed macroeconomic environment.
Agreed.
And remember, this summary has been for informational purposes only. It is definitely not investment advice.
Which leaves us with just one final provocative thought for you, the listener, to consider. We know Costco has this long-standing commitment or philosophy of passing back an estimated 90% of value opportunities to its members through lower prices. So how will they balance the clear need for continued massive investments? We're talking billions in infrastructure, supply chain, technology, and wages, alongside navigating these evolving macro pressures like tariffs and potential non-food inflation, while still maintaining that extreme value proposition for members and potentially even expanding their own margins further over the long term. Where does that balancing act eventually lead?
That's a great question. Definitely lots to think about there. Thanks for joining us for this deep dive. We hope you feel better informed.